Well, hey there, inquisitive finance people. Matt, Efficient Finance Guy here. If you are wondering exactly what my thumbnail for this video means, I am going to do my best to clarify that for you. Thanks for tuning in. I appreciate you being here. In light of some clients that I am working with right now, some conversations I have had with prospective clients right now, and some other conversations that I have had with some local community members, and just some other little day to day interactions that I have had in my world in the last week or two. I just had kind of an all encompassing and broad overview thought here this morning after one phone call that I had where this all kind of came together after the fact. And I this is not scripted. This is not planned. This is just totally off the top of my head. And understand that there is no 100% of the time for 100% of the people. So this is just kind of a broad, um, overreaching idea, thought, or concept here that I wanted to share with you, just to get your wheels spinning and to maybe realize and appreciate the importance and the significance of little action steps that you take throughout your life as it pertains to your finances to help you be in the best position possible long term and to help you achieve as much as you possibly can for your family and yourself. So, with that being said, what does paying your credit card necessarily have to do with owning your home? Well, I'm taking this to a very rudimentary level here. And again, broad overview perspective. Each individual has their own life circumstances. Each individual has their own earnings, their own obligations, their own life expenses, their own variables based on where they live. So, again, and just for absolute clarity here, um, this is bird's eye kind of overview, but I'm just thinking back over, again, some conversations and interactions I've had here recently, and then over the course of my career. And it's interesting to me how oftentimes when I'm looking at all the variables of a client's profile relative to seeing what they can qualify for or afford to purchase relative to a home for themselves, usually if there is a component of their financial profile that, let's say, bowling alley perspective here or reference, let's say it's in the gutter and it's not up on the alley and it's not going to be a strike. In many, many instances, there are often other aspects of their financial profile that are in the gutter as well. Now, again, nothing is 100% of the time for 100% of the people. It is circumstantial without a doubt. So, for example, or just a follow up thought on this, I have seen instances where someone is an extremely high wage earner or income earner, but their credit profile is not so great and it's at the lower end of the spectrum and they're not on an even playing field. Most of the time, when you evaluate someone's household financial circumstances and details, if the income is there to pay the primary life obligations that they have, and then the borrowed money and credit obligations that they have, usually the credit obligations are managed responsibly because the income is there to do it. But there are instances where that's not always the case. The income is there, and there's just a little bit of sloppiness or laziness relative to the credit management. I have also seen people at the lower end of the income or the earning spectrum, and their credit score is exceptional. Now, this is definitely not the norm. However, it's not always about what you make, it's what you keep. And if you manage your credit related obligations and your borrowed money obligations responsibly, even if you're at the lower end or a lower level of earning. It does not mean that you can't pay your bills responsibly and have an exceptional credit score. Now, I'm going to parallel this to cleanliness, let's say in your home or your apartment or wherever you live. It doesn't take a lot of money to be clean. You can shop at Dollar Tree and buy generic cleaning products and still put in the effort to clean your home. You don't need to make a lot of money to buy high-end products to be able to keep your home clean. So just random thoughts here off the top of my head for parallels, but I'm going to pause for a moment since the neighbor's dog seems to be attracted to something at the moment. All right, so we're going to resume. You wouldn't know this, but it's actually the next day now. So I need to get back on track with my thoughts here just due to the dog barking, some planes outside, then the weather, and then my appointments and my schedule yesterday. Didn't have a chance to conclude this all in the same train of thought. So where I was going with all of this, and again, nothing applies 100% of the time to 100% of the scenarios or situations or people or households, but one thing leads to another. And when it comes to your finances, managing your bills, staying on top of what you've got going on, and paying attention to details, again, thinking back to that cleaning analogy, anybody can put in the effort to actually do some cleaning. Some people might do that with Pine Sol. Some people might do it with Fabuloso. Some people might do it with whatever you might buy at the highest end store that sells cleaning products, whatever that brand may be. Regardless of the product, the effort is there to actually do the cleaning. Same thing with your money and your credit management. Okay, if you don't make as much money as someone else, it probably means you can't borrow as much as someone else because your income doesn't support that, so you need to borrow less. But whether you're borrowing a little or whether you're borrowing a lot, whether you have 2 credit accounts or whether you have 10, it's a matter of staying on top of what you have going on and doing the best that you can to manage those responsibly. And the whole point of where I'm going with this ties in, and I can't really get into mortgage related info or details on this particular channel. If you are interested in more about mortgage information and mortgage topics and everything else, there's a link down in the description below. Feel free to visit my YouTube channel for my mortgage career. But because of compliance reasons, I can't get into mortgage details here, but I am certified on a very, very unique home loan mortgage product that is unlike anything most people have ever heard of, seen, or utilized here in the United States. The spirit of this product and the way it works, it basically integrates assets and debt management into one combined instrument. And what it does, if your household numbers allow this program to work for you, it can allow you to be out of debt and own your home free and clear in many instances in 5 to 10 years instead of 20 to 30. So in addition to just the time frame to outright debt-free home ownership, oftentimes that also comes along with a greatly reduced level of overall interest expense over the duration of the loan for however long a given household may have it in place. But it was that product and a conversation that I was having with someone the other day that had me thinking about the whole premise of why I'm recording this video. And that is very simply, with this particular loan product, the entry level to discuss this product as far as the minimum required credit score is much higher than every other mortgage product that exists out there right now. So additionally, with this product, if you're talking about a refinance situation, the equity position required in terms of how much you're looking to borrow relative to the value of the home, or if you're using this loan in a purchase scenario, the actual amount of your down payment, it's not that the requirements are necessarily that different from some other traditional loans that are out there, But the way the pricing on this loan looks, it is more cost prohibitive on the transactional side of it. It may still garner you tremendous savings long term, but when you look at the pricing details on the front side, when you are looking to, qualify for this product and then potentially go to closing with it, if you are at the lower end of the credit score spectrum for this product and you're not dealing with a significant down payment or a large equity position on this product, there are some pricing adjustments that come into play and on the front side can make it look more expensive than what other loan options may look like, even though the longer term benefit may still be significantly beneficial for you. In addition to that, the qualifying standards on this go one step further than what most traditional loans look at. So, with traditional mortgage loans, typically, and again, a broad sense, you're not really allowed to discuss mortgages, but generally qualifying is based on gross income from your W 2 or your employer. And then we look at credit related debt obligation payments. We don't really analyze your net take home pay, and we don't look at your other life expenses. So, utilities, your groceries, gas, other insurances that you may purchase, just as part of life that aren't payroll deductions and that sort of thing. So it takes the qualifying to a whole nother level, because the whole premise of how this product works in terms of being beneficial to a consumer or a household is predicated on what is your net cash flow every month in your household, meaning what is left over after all of your expenses are paid. The more that you have left over every month that could be invested or saved or frivolously spent, it doesn't matter the context here. It is just a matter of, are you living paycheck to paycheck and you're waiting for literally each paycheck to pay the bills that you have upcoming for the next week or the next 2 weeks? Or do you have $500 per month or $1,000 per month or $2,000 per month or $5,000 per month left over that you are able to put into investments or put into a savings account or cash out and put into your safe at home? The greater that number is, or the difference between your take home pay and your monthly life expenses, the more beneficial this product becomes for you. So, tying this all together, given the standards of getting into this product from the standpoint of the minimum credit score requirement and the assets available to put down or the equity that you have in your home if you are a current homeowner, it all comes into play that if you're a younger person and starting out in the financial world and living on your own, and you make a couple of little mistakes along the way that may not seem very consequential, but end up being that way, even if you don't know it at that time. And what do I mean by that? Well, when you get that first credit card or you get your first auto loan, when you're out living on your own as a young adult, if you are not staying on top of making sure that those minimum required payments are made in a timely manner, your credit score is going to suffer. And when you're dealing with a lower credit score, any time that you need to borrow money, and in many instances, and there's variances here from state to state and region to region, but your credit score impacts things more than just borrowed money or, loans or credit cards. So the premium that you pay on your homeowner's insurance or the premium that you pay on your renter's insurance or what the ultimate end user cost on your auto insurance looks like can be influenced by your credit score. So if you're starting out on the wrong foot because you just didn't realize the significance or the importance of managing your credit card balances responsibly to optimize your credit score, if you didn't realize the significance of payments being made on time, it may not. I'm thinking back to an example in around 1997. I had a client that I was speaking with, and they didn't understand why their credit score was so low and why they were having trouble ultimately getting an underwriter to approve their loan scenario. And it boiled down to just inconsistency and basically sloppiness with the way they paid the couple of credit card bills that they had. And from their perspective, in this phone conversation that I was having with them, they were basically like trying to understand why this was such a big deal, because their credit card balances were not large balances. So their minimum payments at that moment in time, before there were some new standards put into place after the Dodd-Frank Act and the housing legislation reform and everything regarding credit cards, one of the credit cards might have had a minimum payment of like $15, another one 20, and I think one of them was like 30 or 35. And they were asking me, like, why is this such a big deal? It's only $20 or it's only $15. And the point on that, from the standpoint of both the underwriter as a human being looking at the credit profile, in addition to how credit scoring models end up arriving at a credit score for you, it's not the dollar amount of the payment. It is very simply, you signed paperwork to get that credit card, and then as part of that agreement is that you're going to, if you use the credit card, you're going to then get a billing statement, and that billing statement is going to have a minimum required payment and a date due for when that minimum payment needs to be in that creditor's hands. So by not adhering to that, it conveys a message of, for lack of a better word, sloppiness, or just lack of attention to detail. So when you're talking about, let's say, an auto lender or maybe an underwriter for a mortgage, if they're looking at someone with a very inconsistent and sloppy pay history, especially if they have job stability and income stability, then that becomes a question of, well, why would someone want to move forward and loan a large sum of money to this person when they aren't staying on top of just little payments that are due? So again, it's not the dollar amount of the payment, but it's that responsibility to take care of honoring what you agreed to under the terms of whatever loan or credit card agreement you signed to be able to get your hands on that money. So my point is, when you look forward, now someone with that lower credit score, due to just mismanaged payments or not being aware of the fact that timely payments are so important on your credit, from that point going forward, when they need to borrow more money, they're paying more for it. So it's a greater strain on the budget. It's less money that could be saved or put toward other things. If you start off on the right foot and you have a basic understanding of how all these little things work together and what the cost savings and benefit can be to you and your financial household as a result of having an optimized credit score, or at least one up at a level where you're not going to be incurring adverse or negative pricing adjustments that are costing you more money, it's always just going to have you in a better position going forward for anything and everything that you do. And the whole premise of me putting this video together and the thoughts that I was having about this were very simply that, wow, if someone were to, let's just say, graduate college, get their first job, start out on the right foot, have limited credit, but credit use managed properly, not too much in debt, so not high debts, but moderate or lower debts relative to their income, pay their bills on time, be able to set money aside and save. It's kind of a snowball effect, because now when they need to go finance their next car or their first car, okay, the terms on that are going to be more attractive than if they were on the other side of the spectrum with some late payments and a lower credit score. So now, once again, the cost of borrowing that money less expensive than what it might be for another household. Well, now you're able to save some money. So now, like, just with everything going forward, if you have more money in the bank when you go to purchase your first home, you have more flexibility and more options if you have some money in the bank to work with, and you have a great credit score, and you have job stability and income that is supporting everything. So now, instead of maybe being relegated to only this home loan option, maybe you have an option on this product and you have an option on this product. Which one is most financially advantageous for you? Then beyond that, tying this in with what I was thinking about with this other home loan program, and what it can mean to a household in terms of being out of mortgage debt in years as opposed to decades, literally creating like generational wealth that a household may not have ever enjoyed or may not have ever achieved if they weren't in a position to take advantage of that product. And since that product does have kind of a higher cost of admission in a lot of different ways, if you're in that lower or middle spectrum when it comes to just money in the bank, credit score, and everything else, you're probably never going to be able to even consider being able to utilize that product. So, doing the little things correctly at the beginning can literally create life altering outcomes that are favorable and positive for you. Even if you take into consideration, aside from credit related items, how are you managing? And this is something that I have another video I touched on and kind of went on into this in depth, but how are you managing your daily spending from the standpoint of like lunch when you're at work, or the stops that you may make along your way to work or on your way home from work? You know, are you overpaying for bottles of water or bottles of Gatorade or sodas at a convenience store when you could very well have those products at home, buy them in bulk at a warehouse, you know, a Costco, a BJ's, a Sam's Club, take them with you instead of paying what the prices are in a convenience store? Are you door dashing and Uber eating every day for lunch? Are you ordering from a restaurant and spending $10 to $15 a day for lunch? Or are you making a sandwich at home with products that you could have bought at the grocery store or again a wholesale club in advance and made that sandwich at home, saving you 10 or 20 or 50 or $100 a week that is now able to be saved and put toward other bills, or allowing you to not have to use your credit card as much? So it all just, one thing does lead to another, and all these things are intertwined to where one little step at the beginning that then leads to you seeing your savings account starting to grow may spark an interest level in making another little change so that you can see that savings account growing a little bit more. And in the case of the other side of that, instead of seeing a savings account grow, maybe it is paying off some bills that have been lingering and you just haven't been able to tackle yet. So one little change here means there's more money available to go toward getting some credit cards out of your life, especially if you have rolling balances and you're incurring interest expenses on those. So all these little things can have a compounding effect for you over time. And I was just thinking about how there's some people that they kind of never get out of the hole. And I fully understand that in this current moment in time, here we are in the fall of 2025, you know, earnings have not kept up with the overall cost of housing. Every day, goods and services and common products that we all need to purchase, in many instances right now, are at all-time highs or very near how much they have ever cost in the past. So I do completely understand that budgeting is more difficult than it's probably ever been for people. Managing your assets properly, having some money left over every week or every pay period is probably for many people more challenging than it's ever been. So I don't take that lightly, but the reality is, if you are paying attention to this, if you are tracking your spending, if you are tracking what money you owe to what creditors, if you are prioritizing purchases that are necessary versus purchases that are wants or desires and not necessarily needs, can you plan to save for that investment or that purchase, as opposed to putting that onto a credit card where if you're not able to pay off that credit card in a timely manner or pay it off within a promotional period, if that's available, now you're incurring an interest expense, you know, on that product, even if it was purchased on sale. The cost of interest when money is borrowed is generally going to offset and then some the savings you might have enjoyed for something being purchased on sale. So there's, again, just a lot of thoughts that were running through my head here. Whole spirit of this is, when it comes to your household finances, put in the time, the effort, and the energy that you would into anything else that you are doing in your life. If you fish recreationally, you probably don't just walk up to a seawall or walk up to the beach and just randomly throw something around out there. You're probably analyzing what's the tide, what's the weather, what's the temperature, what's the wind, what's going on. Is there structure here that might hold fish? What kind of fish are here? What kind of food might they eat? If you are a car buff or a car enthusiast, are you buying a brand new car and then just never washing it and never maintaining it and never getting oil changes and never doing things to that vehicle and just letting it kind of depreciate faster than it would if it was well maintained? Probably not. So why should your household finances, your household money that you work so hard to earn, the money that you borrow, why would you not be putting as much effort into those things that can prove to be highly valuable long term for you and your family as you might put into other things that arguably could be considered a little less important? I hope this message resonated with you in some capacity. If nothing else, I hope it made sense to where maybe it prompts you to make one little change today or this week. And maybe that one little change leads to something a month from now, and things start just getting better than possibly where they are for you right now. I have no idea who is watching this video right now. I have no idea what your current circumstances are. But even if everything in your world is moderately good or above average, there are likely still some steps that could be taken to improve some things a little bit more to just make your life that much better. Thanks for tuning in. Feel free to subscribe, share this video with anyone else that you feel might benefit from this information. And at any point, if you have any questions or there is anything that you would like to discuss, feel free to reach out. And if there are any topics that you would like to see in future videos that I may be able to cover, feel free to comment down below, and I'd be more than happy to see if I could address that for the benefit of everyone in a future video. We'll see you next time. Until then, make it a great day and save away. Well, hey there, if you are still with me, I am truly hoping you enjoyed the content in this video. And if you would like to see future videos with new topics as they become available on my channel, go ahead and like, subscribe. And if you have any younger family members or friends within your family network or circle of friends that are in that 18 to 26-year-old age range, please share this video with them and invite them to check out my online video-based and self-paced Financial Literacy 101 course. You can access that through the website listed on the screen right now, or for simplicity, you could also visit lbf101.com. Thanks for tuning in. Thanks for watching. I look forward to seeing you in future videos. And if there are any topics or content ideas that you would like to see me address in future videos, go ahead and comment down below, and I'd be more than happy to see if I could address your questions or ideas for the benefit of everyone. Make it a great day, and we'll see you again.